Welcome back to the Lance Roberts Show podcast right here at realinvestmentadvice.com. Our special guest today, Michael Pento. He's the president of Pento Portfolio Strategies. And of course, he's also the book of The Coming Bond Market Collapse. And of course, Michael Pento is also the president and founder of Pento Portfolio Strategies, a registered investment advisory firm. Michael, so just for the break, we were talking a little bit about the world at large, quantitative easing, of course. What is China going to do? What's Japan going to do in the event of a next recession? What's the ECB going to do? What can they do? And more importantly, what the Fed will do. Here's my question. This isn't new news, right? We kind of all know this. But I do have a couple of questions for you. First of all, when I look at, say, China's financial stimulus, let's start with that. Let's start with this. When they do financial stimulus, this is great. But the problem is that if I do financial stimulus of 1 trillion yuan this year, and I do 1 trillion yuan next year, there is an efficacy to those interventions. In other words, the year-over-year increase in that credit is being reduced, which means it has less and less stimulus or stimulative impact to the overall markets.
Especially Lance, when those rounds of stimuli are mostly unproductive in nature.
Right. Which also brings us to the other issue, which is the effectiveness of quantitative easing in the next recession from the Fed. President Trump came out recently and said that the Fed should immediately reduce interest rates by 50 basis points and stop reducing their balance sheet. In fact, actually start, increasing their balance sheet again. When we look at how QE worked following the financial crisis, the Fed's balance sheet was about $900 billion in early 2009, give or take. Interest rates had come down a lot on the Treasury bond market, but the Federal Reserve was lowering interest rates towards zero. The economy was completely blown out. Investors were completely, done. They were bailing out of the market left and right. They had stared at the abyss. The abyss had stared back, and they wanted nothing to do with the markets. So there was this complete inversion of the markets. Valuations had come down. Market liquidity had dried up to a large degree. And so when all the stimulus hit the market, the pump was primed to react to this big impact of stimulus. Here we are a decade later, and even if the Fed's balance sheet's now 4 times as much, interest rates are at 2.4%, as you said a second ago, it seems to me that even if we have the next recession, the efficacy of even doubling the balance sheet from here won't have as much of an impact as investors are potentially hoping for.
Okay, so you said a whole lot there. So let's try to unpack this. So
yeah, sorry.
One of the problems that I see out there is a rise of socialism, and the rise in socialism, not only in the United States but around the globe, is derived from the desire to address a real problem, and the real problem is this trenchant, wide, deep-cutting wealth gap. Okay, the gap between the very top of an economy, the 1%ers, so-called, who own a lot of real estate, who own a lot of assets, and those on the very bottom. And what happened is when you go into these rounds of quantitative easings that we had here in the United States, 3 or 4 of them, when the money goes into the financial system first, it goes to the primary dealers. It makes them wealthy. What they do is they buy more assets. They buy more bonds, which are going up in price and lower in yield. And they buy more equities, which are going up in price because yields are going down. Now, you mentioned, Lance, that in 2008, we started this inexorable move towards 0%.
Right.
But the Fed funds rate at that point was 5.25%. So they had 525 basis points to lower interest rates, to reduce borrowing costs, and to make debt service payments more palatable for the public, for the consumers. Today, there's only 250 basis points of interest rate reductions. But I think even more importantly, if you remember in 2008, 2009, Ben Bernanke said that these rounds of stimuli were emergency in nature. Mm-hmm. Emergency, meaning ephemeral, temporary, highly unusual. But those rounds of quantitative easings didn't end until 2014. And here's the point. Central banks around the world have ended up monetizing already. Monetizing means turning debt into money. $14 trillion worth of this temporary, ephemeral, and emergency measures permanently monetized $14 trillion worth of debt. And there is no end. This is the salient issue here. I think investors have yet to grasp this, that not only do they permanently monetize all this debt, but there is no chance they can ever stop monetizing this debt. So the Bank of Japan right now, for example, owns 50% of JGBs, Japanese government bonds, and the Bank of Japan owns 80% of all of Japanese ETFs. Now, they can never announce, the Bank of Japan, Mr. Kuroda, can never announce that he's ceasing and desisting the purchase of these assets, because if that were the case, their prices would plunge in value, yields would skyrocket on JGBs, and the nation of Japan would be revealed for what it truly is, an insolvent island.
But here's a question, though. What happens when they own 100% of the ETF market?
Well, I don't think it'd be much different than 100%. I mean, here's the point. Eventually, investors are going to have this epiphany that what the central bankers had begun in 2008 and are still doing today is permanent in nature. It can never stop. I mean, the Federal Reserve found that out in the fall of 2018.
Yep.
They realized that they can never normalize interest rates. So at 2.25% or 2.5% on the Fed funds rate, effective Fed funds rate at 2.4%, that's way less than half of its normal level.
But Mike,
5.5 to 6. They can never raise interest rates. They have permanently monetized, Lance, $3.7 trillion of U.S. assets.
Let me ask you a question, because I just heard Art Laffer on the news station this morning. I was at the gym working out. Art Laffer is up on television talking about the economy. And he says this is the greatest economy in the history of the United States.
Yeah.
And
so cut interest rates by 50 basis points, right?
Right. So cut interest rates. But more importantly, you just said that this stimulus, this artificial stimulus, the support being put in by the Federal Reserve is for emergency measures. These are measures that are done during an economic crisis like a recession to help, re-stimulate and restart economic growth. But Art Laffer, in a way, is, I don't know if you can call 2.5% growth, the greatest economy in U.S. history, but we do have historically low unemployment. We've got historically low jobless claims. We've got rising wages to some degree. But if we have those aspects of the economy growing, why are we still doing emergency measures? When do you not need them anymore? Or is the economy really not as strong as it looks?
Well, I know Art Laffer, and I've been on television with him several times. Art is a great individual, but he's also a cheerleader for the Republican Party and also for Mr. Trump. I would contend that this is not the greatest economy ever, because it can't be the greatest economy ever when you have unprecedented economic and market distortions. Let me repeat that. We have today unprecedented economic and market distortions. They have never existed to this level before. And let me just go over a couple of things that prove, besides the fact that the middle class is being eviscerated, let's just talk about a couple of things that make this one of the worst and most dangerous economies ever. And by the way, let me just say, I am not a perma bear. I am not a perma bear.
Right.
In fact, I was on TV. I was on TV regularly in 2006, 2007, 2008, explaining how I thought that the housing market was an epic bubble and that was going to blow and cause a very dangerous recession. I then turned bullish in January of 2009, and I was derided for both those moves. So I'm not a perma bear. I'm not a perma anything. But let's just talk about some things that you have to understand. So, and I said unprecedented economic and market distortions. There are some 9, and depending on the day, because it vacillates, depending on the German Bund. But we have about $9 to $10 trillion worth of sovereign debt around the world that has a negative yield. In other words, governments are getting paid when they issue debt. So I would ask Art Laffer, does he really believe that that is a sustainable and viable and normal condition? And does he think that that condition of having $10 trillion worth of debt at 0% does not engender any other further market distortions? I'll tell you what happens when you take $10 trillion around the world and push them to zero and below and leave them there for about a decade. We now have $250 trillion worth of global debt. That is up $70 trillion just since 2008. So when you take interest rates to zero and leave them there for a very long time, people don't deleverage. They actually massively re-leverage.
Right.
Now, let's talk about what else happens. You take interest rates to 0%, you print up all this money, asset prices become in a magnificent, huge, humongous bubble. So the total market cap of equities in the numerator, the denominator is GDP, is now 145%.
Right.
Okay. That's some 90 percentage points above the average. And if you look at household net worth, so you add the total market cap of equities plus you add in real estate, that's now at 535% of GDP. That's 20% higher than it was in 2007, the start of the Great Recession.
Right.
And the total market cap to GDP is 30% higher than it was at the start of the Great Recession.
But Mike, let me be the antithesis here for you. Let me play the foil for just a moment. So what? The problem back in 2007 was clearly the banks taking advantage of, poor households, with these, kind of funny money mortgages. Those don't exist before. And the banks are fully recapitalized. They're in fantastic shape. There's no risk of, another financial crisis. So I'm not sure what you're belly aching about here.
Well, yeah, exactly. Well, I mean, banks are recapitalized if you don't count the treasury bonds that they hold as part of their capital. So, I mean, if they have a zero risk weighting, I don't want to get too far into the weeds, but when you count the fact that they own all these treasury bonds, and if bonds were to collapse in price and skyrocket in yield, banks would be pretty much insolvent.
Right.
But let's just concede that banks are slightly more capitalized, even if you do include that metric that I just mentioned. Let's talk about the level of corporate debt that has skyrocketed all the way up to $9 trillion since the Great Recession. Right. Okay. By the way, there's a record amount of corporate debt, a record amount of junk bonds. They have the lowest credit rating ever. So the amount of bonds, the $9 trillion in bonds, if you look at the amount of bonds that are actually junk or just above junk, it's 66%. So 2/3 of the entire bond market is junk or just one notch above junk. So this is what you want to know why Jerome Powell panicked in the fall of 2018, because if the economy even shrinks a little bit, just a little bit for a very short period of time, even if we have a minor recession, it's going to devolve very quickly into a depression, because you're going to have companies, these zombie companies that have exploded in size and in amounts. Mm-hmm. They would all zombie company. Let me just define that. They have to issue debt just to pay the interest on existing debt.
Let's see. Wait. So if you're borrowing money from somebody to pay the other people you owe money to, that's called a Ponzi scheme.
Well, the Ponzi scheme, yes. And there's a record amount of those zombie companies running around out there as part of that 66% of corporate debt that has exploded in size. So if you have any kind of downturn in the economy, these corporations, these leverage loans will go bankrupt. The corporations will go bankrupt. The high yield bond market will implode. This was all happening. And this is not a Cassandra, standing on some rooftop, saying that the flood is coming. This already happened in 2018. And so, I have a model. This is, again, I don't manage money by buying gold and shorting the market. That's not all I do. I have a model, a very powerful, robust model that tells me what's the high yield market doing? What's the LIBOR spreads? What are junk bond spreads? What's break-even spreads doing? I have a 20-point model. I'm not going to go into all the components of it, but it lets me know when it's time to short the market. And given the fact that we have a record amount of debt outstanding, a record amount of corporate debt, central banks have destroyed the free market all over the globe. There is no free market for JGBs in Japan. There is no free market for sovereign debt in Europe. There is no free market for Japan equities any longer. It's all artificial. So yes, it looks great to Art Laffer. Things look fine because look at the unemployment rate. Like if you don't count all the fallow workers who have left the labor force, I guess it looks fantastic. But listen to what I've told you. Look at the amount of debt that's outstanding. Look at the artificial construct of interest rates and tell me things are normal.
Let me ask you a question. So, because you're a great numbers guy and you've got these numbers on your fingertips. So, as compared to 2008, when we were having the housing bubble, and when you look at the amount of mortgage debt that was really the problem that really accelerated the financial crisis. How many trillions of dollars versus a mortgage debt versus how many trillions of dollars of potentially bad corporate debt? Are those somewhat equal?
So just take the corporate debt, okay? Just take the corporate debt. Just the amount of leverage loans outstanding, close to $1 trillion of leverage loan equals the amount of subprime debt that we had in 2008. That's just one piece.
Right.
But we had a housing bubble in 2008. That was pretty much it. Now we have a global sovereign debt bubble, a housing bubble, a credit card bubble, a student loan bubble, an auto loan bubble, and a stock market bubble. Now, remember that ratio of total market cap to GDP, which is 145%, had only one data point in history was higher than that level, which was March of 2000. The peak of the NASDAQ bubble was the total market cap of equities hit 149% of GDP. But back then, to make you even more nervous, back then we actually had a pretty much real economy. The economy back in the year 2000 was more real. Today it's much more fragile because it's all predicated upon free money forever.
Let's take a quick break right there. We'll come back with Michael Pento right after the break, right here on the Lance Roberts Show podcast at realinvestmentadvice.com.
Want a longer talk with Lance about your money? Request a personal one-on-one at realinvestmentadvice.com.